Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Hey everyone, and welcome. Today we're going to untangle something called the Premium Tax Credit. Now this is a government program that can save you a ton of money on health insurance. But, and this is a big but, if you're not careful it can also lead to a surprise tax bill. So we're going to show you how to make sure it works for you, not against you. Let's be real for a second. Doesn't paying for health insurance sometimes feel like you're trying to solve an impossible puzzle? You've got all these pieces, premiums, deductibles, and you're trying to make them fit into your budget. It's a lot.
But what if I told you there's a key piece of that puzzle that's actually designed to help? We're getting our info on this straight from the source, the IRS. They call it the Premium Tax Credit, or PTC for short. And it's basically the government's way of trying to make health insurance more affordable for millions of people.
So to figure this all out, we're going to follow the taxpayer's journey. We'll start with the basics. What even is the PTC? Then, how do you get it? What happens when your life changes? And trust me, that part's important. We'll talk about tax time, aka the reckoning, who's even eligible, and finally, the key things you absolutely need to remember.
All right, let's dive right in. We're going to start at square one. What exactly is this credit?
Okay, in the simplest terms, the PTC is money from the government to help you pay for health insurance you buy on the health insurance marketplace. But the real magic word here is refundable. And what that means is, even if you owe zero in income tax, you can still get the full credit back from the government. That's huge.
So you know what it is. How do you actually get your hands on this money? Well, right from the get-go, you've got a big decision to make. You've got two paths you can take. Option one, and this is what most people do, is you can get the credit paid in advance. You just estimate your income for the upcoming year, and boom, the government sends a chunk of money straight to your insurance company every month. The result? Your monthly bill is lower. Or there's option two. You can pay the full premium all year long and then claim the entire credit when you file your taxes. It's less help month to month, but it could mean a really nice big refund check later. Now, here's a super critical point. If you choose those advanced monthly payments, your job is not done. This is not a set it and forget it kind of benefit. The amount of credit you're supposed to get is tied directly to what's going on in your life. So if any of these things happen, you get a raise or lose your job, you get married, you have a baby, you move, you have to tell the health insurance marketplace right away. Why? Because all of those things can change the amount of credit you're supposed to be getting. Keeping them updated helps them adjust your payments on the fly so you don't get a nasty surprise at tax time. And that brings us perfectly to tax time. This is where the rubber meets the road. At the end of the year, you have to square up with the IRS. You have to reconcile the advance credit you got with the credit you are actually supposed to get. I want you to think of those advance payments like a gift card. The government gives you this gift card based on your estimated income for the year. But when you file your taxes using this special form, Form 8962, you're telling the IRS what your actual income was. So, now it's time to find out. Did you use the right amount on that gift card? So, what happens next? Well, one of two things. If it turns out your income was lower than you expected, it means you didn't use up your whole gift card. The government gives you the rest of that money back, and it gets added to your tax refund. Sweet! But if your income was higher than you estimated, you used too much of the gift card, and you have to pay back the difference. And listen, this is a really big deal. For years, there have been caps on how much you had to pay back. But as the IRS says right here, for tax years after 2025, those limits are going away, gone. That means if you get too much money in advance, you are going to have to repay every single penny, no matter what. Okay, so after hearing all of that, you're probably asking, wait a minute, is this credit even for me? So let's run through the official checklist from the IRS. First off, your income generally has to be in a certain range, usually between 100% and 400% of the federal poverty line. Now, there is a temporary rule change that gets rid of that upper income limit through 2025, which is great news for a lot of people. You also generally can't file your taxes as married filing separately. You can't be claimed as a dependent on someone else's tax return. And of course, you have to actually be signed up for a marketplace insurance plan. Now for the big deal breakers. If you have access to what the government calls affordable health insurance through your job, you are not eligible for this credit. The same thing goes if you're eligible for a government plan like Medicare or Medicaid. You can't have both. It's one or the other.
So what in the world does affordable even mean? Well, get this. The definition actually changes every single year. You can see it right here.
The government sets this percentage of your household income. If the insurance your job offers you costs less than that percentage for the year, it's considered affordable, and you can't get the tax credit. And just look at how much that number jumps around. It's wild.
Okay, I know that was a lot of ground to cover. It is definitely complex, but it really all boils down to just a few key things you need to do to make sure this credit is helping you, not hurting you. This right here is basically your action plan. Step 1, choose your path wisely. Do you want help every month or one big check at tax time? Step 2, and this is the big one, report life changes the second they happen. And step 3, you absolutely must file a tax return with Form 8962 to settle up. Even if you don't normally have to file taxes, if you got advance payments, this is not optional.
So I'll leave you with this question. Is your tax credit working for you, or is it working against you? This credit can be an incredible lifeline, but only if you stay on top of it. By being proactive and staying informed, you can make sure it's a helping hand and not a source of debt.